Welcome to Genomics. I'm Latha Venkatesh. India's GDP growth for the third quarter came in at an eye-popping 8.4%, with quarter one and quarter two also being upgraded above the 8% mark. Puzzlingly, a lot of the growth has come from net taxes, which means either higher indirect tax collections or lower subsidies or both. The other worry is that consumption is still weak, growing by just 3%, while investment is doing the heavy lifting, growing by 10.6%. Savings and investment as a percentage of GDP are rising, but not anywhere at previous highs. What does all this mean for growth going forward? I have with me three economists to parse the GDP numbers and forecast the future trajectory. Upasna Bharadwaj, the chief economist at Kotak Mahindra Bank, Sameer Narang, the economist at ICICI Bank, and Madhavi Arora, the economist from Emkay Global. Ladies and Sameer, thank you very much indeed for joining me. Well, Upasna, let me start with you. The number 8.2 for the first quarter, 8.1 for the second quarter, 8.4 for the third quarter. And then if you subtract, it comes to a very low 5.9 for Q4, if you estimate from the full year 7.6. Are we underestimating Q4? Are we actually going to get a FY24 number of 8%?
Latha, there are two things to keep in mind here. One, we do see slight amount of upside to the possibility of a 5.9% that the government has implied, but especially from two aspects. One is that the corporate earnings could be slightly better, so the manufacturing manufacturing segment could be outperforming the government estimates, and the other upside could come about slightly from the agriculture side, where we will get the next advanced estimates of the annual numbers. So I think these two are segments where we do see scope. Having said that, if we look at the sequential momentum of overall GVA, that is estimated for the fourth quarter compared to the pre-pandemic averages, if we were to look at, then that too is estimated at a much higher level. So, while the momentum is strong, and we have already seen the first three quarters being revised significantly up, so there is a possibility that the momentum remains much higher than the pre-pandemic levels, but that is already incorporated in what the estimates are. And at the same time, there's an adverse base effect too, which is likely to pull down the numbers. So maybe not too much of a deviation from 5.9, but maybe 10 basis, 15 basis upside is possible.
Okay. Well, actually, let me put the same question to Sameer. I find it extremely intriguing that by implication, I mean, if you subtract the 9-month numbers from the full year implied numbers, I mean, 5.9%, look at the PMI number that's come in for February. January was also just as strong. The auto sales numbers are very good. That's we already know. So Jan, Feb, we know have been strong on auto sales, strong on PMI. Of course, core sector has been weak for January. I'm a little at a loss. Are we going to come closer to 8 than the NSO is admitting?
So I think, Latha, the other part which will probably prop the GDP growth for Q4 is again the subsidies element. Subsidies were down more than 50% in Q3. And what you'll see is that even in Q4, subsidies are estimated to be lower by 20-odd%. And one should also remember in the financial year 2020-21, when the GVA growth was close to 4.1, 4.2%, the GDP growth was negative 5.8. So there was a large wedge which was there in that year. And a similar wedge is opening up in terms of when the subsidies are getting revised lower, because that is the point in time when subsidies have actually gone up. So essentially, there is a statistical quirk that is happening in the data, but we should also remember that the previous estimates for H1 for GVA also have been revised higher by 30-40 basis points for each quarter. So if you ask in terms of how the high frequency indicators are playing out, I would tend to agree with you that there is an upside bias to what the numbers are being doled out right now by NSO. Our own number is actually higher for Q4, and that implies that the overall number for the year could also be a tad bit higher.
Then why don't you tell me those numbers, Sameer? What are you working with? What's a working number for FY24 itself and therefore FY25?
Yeah, so for FY25, our number is 6.5%.
Okay.
that comes down from the numbers you are seeing right now because of the
High base.
superlative growth we are seeing right now.
Yeah.
Fiscal consolidation, the subsidies element is not likely to be there. However, within the overall GDP numbers, we do believe consumption-led growth will continue.
Okay.
If you see
No,
household
Samir,
investments in physical,
Samir, I want to know whether FY24 can be higher than 7.6.
yeah, I think the way the numbers are laid out for Q4, it will be higher by another 10 to 20 basis
Okay.
points from what the CSO
So
is
we may
estimating
be
right now.
actually at 7.7 or 7.8. That possibility exists. Now, Madhavi, for the stronger number that Samir was almost alluding to, we have seen FY22 getting upgraded from 9.1 to 9.7%. I looked at the actual GDP numbers. The real GDP number is up by 1 lakh crore. I mean, that's quite a significant revision. The FY23 looks optically lower from 7.2 to 7%. But if you look again at the real GDP number, the number is up from 160 lakh crore to actually 160.7 lakh crore. There is an up of about 65,000 crores. So, can we say that we are on a very firm growth trajectory that, even subsequent years, we should be doing at least 7% for, FY25? Because systematically numbers are getting upped.
Yeah. So, Latha, I agree with you. I think we all have underestimated the India, underlying growth story. Beginning of the year, if you'd asked any of us that if you're expecting even a 7% growth in FY24, most of us would have been a little more skeptical. And, if you look back, most of the forecasts were hovering close to more around sub 6.5%. We all have gone through the year. Every quarter has surprised on the upside. Historical data also has been revised up on a net basis, which of course again shows that the revised data, which also incorporates the unorganized sector, has not been as weak as we initially estimated. So obviously it shows that the underlying momentum has been somewhere missed by most of us. Unfortunately, what I'm seeing, at least for this particular year, is that there's been a very wide divergence on a quarterly basis between private consumption and GFCF.
Yeah.
That has been widening. The growth has been consistently widening. So you are coming to a situation which is very much like a China growth model in early 2003 to 2011-12 period, where you're seeing a massive growth in investment, but not a very strong consumption story. But at the same time, China was essentially a export-led economy, so they were able to export their excess capacity outside of their economy and could grow at a different level. In India, what's happening at this point in time is that you don't have a very strong consumption demand, at least so the numbers show. But the investment demand or investment capacity have increased massively over the last 1.5, 2 years, specifically this particular year. And exports have remained sideways, if not, weakened in FY24, which also sort of implies to the extent that the excess capacity is going to stay back at home, given that we're not an export-led economy as such, and would eventually somewhere, lead to a supply-led fall in inflation domestically, core inflation, specifically speaking, which also sort of is reflected in the fact that last 1 year, core inflation has been steadily coming off while food has been volatile for whatever reason. Okay. So I think the intrinsic demand in the economy is relatively low, while supply side is actually, improving dramatically. So the near-term impact will be lower intrinsic inflation.
Okay.
But maybe in the medium term, you could actually see a higher potential growth also. That depends on how the growth model of India actually evolves.
Absolutely. That is the larger question we should be asking. This consumption investment disjunct, which Madhavi spoke about and all of you have written in your reports, 3% growth in consumption, and actually if you do the implied number for fourth quarter, it actually falls to 1%. If consumption is so weak, will private capex ever pick up the baton from the government, or will it be afraid that demand has not picked up? So therefore, can this low consumption come in the way of sustained growth? Samir, that question to you. Consumption consistently lower. Do you think that will stymie private capex from doing more because, well, demand is not there?
No, Latha, along with the GDP numbers, we also had announcement that 4 fabrication semiconductor plants are being set up in the country. It's a first. So I think the investment life cycle is driven by energy demand. Our the power capacity utilization is now at 72%. Last time when we saw these numbers were a decade back. So what we are seeing is a consumption-led growth, which is happening in key critical sectors such as power. We are looking at more and more investments in electronics manufacturing. We are looking more and more investments by the government in railways, in roads. All of that put together, including airports, all of that put together is going to drive much higher investment going forward. On the consumption bit, when you look at travel, when you look at consumption in personal services, there is an accelerated growth that we can see in some of these sectors. So I think within consumption, it's a dual story. There are sectors and categories which are doing exceptionally well, and there are categories such as FMCG and certain other durables which are underperforming not only in India but globally as well. So that story actually is fairly consistent in India as well as globally. But there are certain services within consumption which are doing exceptionally well.
But the aggregate is not adding up, is my sense. I mean, nobody's really betting that the government capex cycle, the baton has been picked up, convincingly by private capex. Upasna, back to you. We hope we can hear you now. What's your sense? Because of the weak consumption demand, you think private capex will not go gangbusters?
Yes, Latha, I was mentioning that. I think that is a big worry for us, going ahead, because this divergence cannot sustain beyond a point. Something has to converge. So clearly, if and when consumption does pick up, we could really see capex, private capex revive. But at this point, my fear is that we have some more legroom for consumption to remain muted. We are getting very mixed response from the rural side. And if that kind of a slowdown continues, then the second half of the year, which we are kind of looking at a possible revival in private investment, that is something which is going to pose a risk. So capacities that we're talking about may not really materialize the way we are looking for at this point in time. My fear is this divergence is something which we have to be very cautious about.
Okay, fair point. And that will be the questions I'll be posing to you all after a very short break. Has India's incremental capital output ratio improved, or will it improve because of the capex cycle that the government has started? As well, will global moves be a headwind, or will it actually be a tailwind? Because it looks like big economies like US and Japan are still ticking fine. Those questions after the break. The apex statistical body stunned us with a Q3 GDP number of 8.4%, but some of us have dug deeper to find that the actual value added in the third quarter was only 6.5%, in line with expectations, and that taxes and subsidies did some of the heavy lifting, which perhaps cannot continue. But what about the future? Will the government capex, which has been steady for the past 3 years, improve the capital output ratio? So that's the question I want to ask my guests. Upasna, Madhavi and Sameer, thank you very much for your patience, for staying on. That question to you, Madhavi. Do you think capital output ratio will or has already shown signs of improving?
I think to answer your question, I firstly believe that the consistent policy focus on capacity creation is still justified. I believe that the marginal returns of public investment is still high, and the supply side policy push, which is leading to asset creation, will eventually prepare the economy pretty well for a non-inflationary growth path, where whenever, as and when there's a structural pickup in demand. Of course, the near term looks to be a little patchy story, where we can sort of argue that there are certain inefficiencies which are leading to higher iCOR and certain segments of the industrial economy, but not across the industrial economy. But I personally believe that it still makes sense for at least the public sector to continue to invest at this point in time, because the country still remains deficient in basic infrastructure, and there is still merit to getting into that. For them, how to sort of optimize it going ahead and how to monetize it beyond what they've done in the last 5 years is going to be a bigger question for them. But at least the intent and the motive looks to be justified.
Yep, and there could be an argument that perhaps a little push could have been given to consumption, considering that that's the weak link. Of course, Somanathan firmly put that down, saying it's not the government's job to increase consumption. But let's see, if that begins to stymie growth, then perhaps the government will have to take some action. Sameer, what about global scenario? we have been living all of FY24 in the fear that there will be global headwinds and, tighter cost of capital or higher cost of capital because of interest rate increases. But that's not what's happened. The US has consistently surprised us on the upside. 3.2% Q4, 4.4% Q3 growth in the US. Japan as well showing signs of growth after a long slumber. China, if anything, is expected to be better than last year, as the worst of the property bubble is perhaps behind them. Given that, do you think we are unnecessarily worrying about global headwinds? After all, exports have not fallen.
No, I think, Latha, you've hit the nail on the head. Even now, with the data that is coming in from US, even from Europe, the incremental PMIs that are coming in portend or tell you that perhaps the global economy is doing a lot better than what we have been thinking about it. And that has implications for asset markets, particularly capital flows. While it may delay the Fed cut cycle by a couple of policies or a couple of months, but it also tells you that if you are looking at a soft landing in the global economy, then inflows into emerging markets can pick up materially. In India's case, for instance, after a gap of 5 years, we have seen debt inflows as India is getting included in the debt global bond indices from June onwards. And FPI inflows in equities is fairly robust. And when you dissect the FPI inflows into equities, you realize that most of the inflows are actually coming in capital goods sector rather than financial services or others, and in autos. So what you are seeing is that the way the economy is performing, the government policy is performing, capital is also moving in line. And perhaps these trends will actually accelerate going forward. The only risk for India and globally has been that FDI inflows into China have been, you've seen massive outflows. And India also, the gross inflows have not receded. A lot of outflows have happened because of repatriation of capital. I think these trends will also change as India's growth is high and India is looking at much higher ROEs in the coming years, as we are seeing in terms of expanding margins. So my sense is that you should see prepare for a much higher inflows to finance India's growth cycle in the coming years.
Okay. Actually, for me, this period seems to rhyme with what we saw between 2004 and 2008. Every year we worried that US is raising rates and therefore growth is going to slow down. It didn't. It didn't slow down in the US. It didn't slow down for us. So sometimes it just reminds me that maybe the very fact that the US is not cutting rates is an indication, of course, that growth is strong over there. And perhaps that will be a tailwind and not a headwind. Upasna, the most important question, where does this leave interest rates in India? How would the RBI look at a stronger than expected growth, and therefore do rate cuts get pushed out?
So Latha, we have to look at things in a holistic manner. Domestically, yes, the GDP number is extremely strong. But having said that, we should look at the GVA number, which is a real activity indicator, and that remains broadly unchanged for now. Let's say even if there's an upside, we're looking at 6.9 turning into a 7, which is broadly, it's not really suggestive of a super surprise to the expected growth path.
Madhavi, very quickly, let me get to the interest rate questions with both of you. Are you expecting the Reserve Bank to push back rate cuts simply because even when it meets in, say, July, it will have the May number with it, and it meets in June, it will have the May 31st number. And if that is higher than 7.6, how can they even talk about a cut in June?
They would be looking at a more stable production side data versus the GDP number, which has been extremely volatile this year, which is not that big a surprise for the Reserve Bank. They were actually much better than street in terms of estimating the growth picture, at least. So I think that does not change much for them. In fact, now there's a big debate that's happening within the RBI MPC that whether we're looking at a much higher potential growth, and thus the whole overheating of the economy is an overrated argument, because probably the potential growth itself is 7.5 plus. So thus we are probably still undergrowing versus our potential growth. And
so I mean, your rate cut, we don't have time. So when would you put the rate cut expectation?
I think it's pretty much pegged to the Fed. I'm being very blunt about it. While we can make multiple arguments domestically, what's happening, what's not happening, when it boils down to financial stability, nothing supersedes that. So we are pegged to the Fed.
Okay, but we are going to be very strong in terms of flows. Remember, the bond inflows start coming in with greater ferocity.
That will be a problem for the Reserve Bank as to how to manage
Absolutely.
it. That will be a difficult
I'm
problem.
sorry, we have to wind up the conversation. Just 10 seconds for Samir and Upasna. Samir, what do you expect in terms of rate action and when?
I think October is when one can expect the rate action. Change in stance can happen, a policy before that.
Okay.
A lot depends on the Fed as well.
Okay, yeah, absolutely. Upasna?
The later, the better. So I would also go with Samir. October is the earliest we can think of.
Okay. Well, we have to leave it at that. Unfortunately, out of time. But this looks like an extremely robust growth story. And our economists are also convinced that because of net taxes or whatever, chances of the full year growth coming closer to 8% are very much on the table. And next year's growth forecasts are also going to be upgraded. Currently standing at around 6.5%, but looks like everyone is on the front foot to upgrade it closer to 7%. That's a great position to be in. We wrap up on that note. Thank you very much for watching this edition of Indian Economics.